Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Good to see you again. I am Lee Kelso here with Casey Weade and Marshall Johnson, certified financial planners with Howard Bailey Financial. Well, here we are. The stock market is in record territory. Are you a little bit on edge? Now is the time to keep cash around, maybe for a buying opportunity? Well, if so, what's the smart way to play that game? That's first on our agenda today. Then a viewer asked us about a home equity line of credit and whether that's a good thing to use for an emergency fund when you're stepping into retirement. You think that's a smart strategy? And then we'll close in the program with a case study for you to review. So we're going to start right now with that focus on cash. And they always say cash is king, but with the market's so darn high right now, what's happening in the cash world?
Yeah, I love to talk about things on the show that Casey and I see in the office. And it's a good barometer when I'm sitting down with new families throughout the week and we're just trying to understand where people's heads are at. And lately I can't help but think of my favorite Warren Buffett quote that says, "Be fearful when others are greedy and greedy when others are fearful." Because I'm starting to see more of a risk-on appetite in being an advisor through 2008 and seeing folks lose tremendous amounts of money and seeing that lasted for a long time, Casey, where people were just more concerned about protecting. But now we're starting to see a little bit of greed creep back in, and people are kind of looking at the rates of return going, geez, is my guy doing enough? I need to get a second opinion. So it's time to just notice when that spidey sense starts to go a little bit.
Oh yeah, and we had a gentleman that we met with just the other day here a few weeks ago, I think it was, and when we sat down, he'd been out of the market for the last 8 years.
Yep.
And had been sitting in the cash for the last 7-8 years, concerned about the market waiting on the next shoe to drop, and guess what? It never dropped.
Yeah, he missed
and
200%.
Now he goes, well, maybe it's time for me to get back in. Things really are looking positive. You're going, well, now let's do exactly what they tell us not to do, which is buy in at the top, right? We're supposed to buy low and sell high, and we're seeing more people wanting to get more aggressive at this time, getting greedier at this time than those individuals that should be thinking about getting more conservative or setting some money on the cash on the sidelines. It's okay to invest a little bit more conservatively when we see the market at all-time highs, when we see the engine running as quickly as it is. It's okay to miss out on 1 or 2 points of gains in lieu of the opportunity to hit those home runs that come by carrying a little additional cash. And I know, Lee, you've had these same concerns, and a lot of the people that I've met with also carry some cash, and there's nothing wrong with that. And there's more reason to do that than just what we're seeing in the office from day to day. And I want to start by sharing with you a few charts. And one, well, we've talked about a Warren Buffett quote, right? We're going to also talk about Warren Buffett's cash levels. So Warren Buffett is known as the Oracle of Omaha, one of the best investors of all time, and one of the most world-renowned investors that's still alive and really killing it today. If we take a look at the cash levels that Warren is carrying today, we see in Warren Buffett's portfolio record high cash levels, and he's not the only one that's carrying record high cash levels. This is where the smart money is, right? We can also take a look at the Shiller PE10. That's the price to earnings ratio, or the price that we're paying for the market's earnings. So we see today, this blue line takes us to Black Tuesday. We get back to 1929, the Great Depression, where we saw market prices hit second to all-time highs. Now we find ourselves here in the third most expensive market in history with a PE ratio of about 30. We're only being a little bit less expensive than we saw back in 2001 and 2008. So it's a very expensive market. That's like paying $3 million for a business generating $100,000 annual income, or I should say, and so that means it's going to take us a tremendous amount of time to ever get back what we actually invest in the market unless earnings are growing at a very rapid pace. Next up, we can also see that we're in the second longest bull market in history. We haven't seen a correction for some time, and we can go back. The only time we've ever seen a longer bull market was in the 90s, back through the 90s and late 80s. And prior to that, we would go back to a period of time in the early 80s and mid 80s. So we're finding ourselves in one of the longest bull markets in history, and we know after every major bull market, like we're seeing today, we've seen these pullbacks of not just 10 or 15%, but in some cases 20, 30, 40, or even as much as 50% once that bull market decides to come back to reality. We're also seeing the highest global debt levels, not just personal debt. We're talking about public debt across the entire globe is getting to the highest levels we've ever seen throughout history by a wide margin. We're also seeing the highest record corporate cash levels out there in history today. And so you have to ask yourself, if the smart money is sitting in cash, we've got small caps at 15, 20% cash, we've got large caps at 8 to 10 or maybe as high as 12% cash. If that's the smart money, if Warren Buffett is the smart money, then why does my advisor continually want to keep me invested in the market? Is it really for your best interest, or is it your advisor's best interest?
So what's your read? How much cash should I be keeping right now?
You know, I think a lot of that depends on what stage of life you're in, whether you're still in those accumulation years, are you in those retirement years, are you in the distributive years? So a lot of that depends on where you're at.
Yeah,
right?
and I'd say if you're in that accumulation stage, you might want to keep some cash on the sidelines that's maybe a little bit higher than when you have a guaranteed income source. That might be 3 to 6 month emergency fund that you can start with before you even start saving for retirement. And once you start saving for retirement, don't put everything in your 401k. And if you do have a lot in your 401k, it's okay to keep some in cash, especially in a market like we have today. Keep 5, 10% of that portfolio in cash in lieu of those opportunities that will, and I mark my words, they will present themselves, whether that's next year or 5 years from now, they will present themselves, and you don't want to be left holding the bag. You want to be like these companies that are going to be waiting to pick up that real estate on a discount, to pick up other businesses at a discount. You want to be the one that's picking up the bag, not holding the bag. And that's what you can do in those accumulation years, but you can do the same thing in your retirement years. And in your retirement years, I say, let's keep a good 6 month emergency fund, because we can't go back to work, and it's really nice and reassuring if we have another 12 or 24 month emergency fund. And I myself, I like to do the same thing. And part of that's because I'm a business owner. I think business owners have to be very cautious with the amount of cash that they keep around, not just for their employees' benefit for those hard times, but look at the biggest corporations in the world. They sit on more cash because that's where companies really make a name for themselves, is during the bad times, not in the really good times.
So where does John Q. Public keep cash right now? With interest rates so low, it's painful to be in a traditional vehicle.
You mentioned 401ks, and one thing that most people don't realize is a lot of times you have a stable value fund. So if you're still in those accumulation years, short-term bonds or a stable value fund, that typically those are free from losses.
There's some great stable value funds out there at some companies. They're not at every company, but for instance, Lincoln is known to have one of the best stable value funds in the area. And so if you're with Lincoln, really might want to think about taking advantage of that with your cash. There's also just cash, money market, checking. It's okay if you're only going to make 1 or 2%. There's also other options out there. I had a couple that came in the other day who had an old whole life policy making 3% a year in that whole life policy, and it was totally liquid. And so they said, you know, we could use a little additional insurance. We can add money to it and take it back. So we went ahead and moved some of their emergency fund into that whole life policy, knowing if they take cash out, the death benefit's going to go down, but that's okay. It fills a temporary death benefit gap need, and now it's making more than they could get at the bank, and it's liquid. Those types of creative options are out there if you look away from your broker and to a true financial planner and someone that's really independent and has all those options available to them.
Well, let's get you started down that path. For the next 10 people who call us right now, we're offering a complete review of your financial and your retirement plan. It gives you the opportunity to get an education about your money so you can make the very best decisions possible going forward, and it's complimentary. So for the next 10 callers, Casey and the team are willing to make time on the calendar, sit down, visit with you, and give you your very own purpose-based retirement. We're jumping out to the phones to take questions from viewers next.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
If you have a question for Casey or Marshall or the team, you can always email it to info@howardbailey.com. We go through those questions, pull out a few, and invite those people to join us on the phone for the program. And that's what we've done with Don from Fort Wayne. Go right ahead, Don.
I don't have a lot of extra cash because I've always put as much as we could into retirement accounts. I know you recommend building a retirement emergency fund of 6 to 12 months of cash, but we just don't have it, and we're only a couple of months away from retirement. What do you think about using our home equity line of credit as our emergency fund?
Well, Don, I just want to give you a couple things to think about. And one, hey, you're not alone. We have a lot of folks that walk into the office that want to know if they can use their HELOC for that purpose. You know, can I use my home equity line of credit for my emergency fund? You say, well, I can get to it anytime I want. I just draw on it. What's the problem with that? And I would say, you know, there's not necessarily something wrong with that. I just think you have to really think long and hard about what that's going to look like in the future. So here's some things for you to think about. One, how disciplined are you? Are you disciplined enough to not pull on that for your discretionary expenses? Because you don't go in debt for discretionary needs. And I think when we have the ability to take that line of credit, sometimes it just doesn't feel like real money. And it is real money because someday you have to pay that line of credit back. And so it can be sometimes too easy to go in there and take these loans and build up additional debt while we're in our retirement years for those discretionary things. So one, if you're going to do this, make sure you're extremely disciplined and we only use it as a true emergency fund, real emergencies. Number two is how secure is your income strategy? Because as we said, that loan has to be paid back, and the more you take, the more you have to pay. And when you take that loan, you have to make those payments. So if the market's down, are you still going to be comfortable making those payments back for that line of credit? And if you have a risk-based strategy versus a guaranteed income strategy, that might really affect whether this is a good idea or not. If you have a risk-based strategy and you have an emergency and the market comes down and crashes at the same time, you may not be able to take additional income from that portfolio versus if you have guaranteed income sources, your Social Security pension, maybe you've created a guaranteed income stream from an annuity. If you have those incomes, now you know you have that room to take that line of credit and always be able to make those payments. And the third thing is, and I think this is probably the one that's most overlooked, you feel like that home equity line of credit is very secure. Well, is it? I can take you back to 2008, 2009 and tell you person after person that I met with who had their line of credit either reduced or eliminated altogether. Those lines of credit that you get are not guaranteed by the bank. They can fluctuate. They can be taken away completely or just reduced. So keep that in mind at the same time. While that's very rare and it doesn't happen very often, they are not guaranteed guaranteed emergency funds. And I personally think your emergency fund should not just be liquid, and should not just be safe, but it should be something that's guaranteed to always be there for you no matter what's going on in the market and the economy.
Are you talking about a mason jar in the backyard?
Well, that is guaranteed as long as you have a good map.
Yeah,
and I can tell you
dog.
also stories about people that drew very bad maps.
Yeah.
And so I don't know that that's the best place, but maybe if you have a nice safe in the basement, you might keep a little additional cash there. But even your savings and checking, there's nothing wrong. And people seem to be a little ashamed at times to say, well, I've got $100,000 in the bank, or I've got $2 million in the bank. And that's okay. There's nothing wrong with that, especially in the world that we're living in today. We've got a market that's overblown. We've got interest rates that are all-time lows. So even if you want to take that and move it someplace, you might only be getting an extra 2, 3, 4%. So
it brings up another point. You're talking about having $100,000 at the bank. Well, I guarantee you, if somebody's watching this and they have $100,000 at the bank, they've been approached by the people at the drive-through window going, you know what, you got an awful lot of cash there. Maybe you should talk to one of our investment advisors. And you know what? That is the difference between banking today and the banking 30 years ago with the Glass-Steagall Act, is now our depository banks, our savings and loan institutions, can also be investment banks. And so they've got an investment guy. So they're proactively trying to recruit those dollars. It's okay to have safe money, like you said.
Yeah,
but also
I love it. And I mean, for me personally, it's like I've got the majority, I wouldn't say the majority, a little over half, okay, of our personal investable assets are in cash or cash equivalents. And those cash or cash equivalents, or at least are making something. They're keeping up with inflation every year, but I think we're looking at a better opportunity at some point in the near future, and it's just not here right now. So there's nothing wrong with keeping a little additional cash. I just don't want it to be a HELOC.
And I think the HELOC's okay if it's the second or third emergency bucket, right? You can have that 6 months into 12 months, and then you have the home equity line of credit. So just in case there's a major emergency and you need to help the kids out or need $30,000, it's okay to use the equity in your home, just not for that primary emergency fund.
Oh, that's a good strategy. Okay. We have to leave it there, so we're going to move ahead to Patty. Patty, let's get your question for Marshall this time around.
I am very fee conscious, so I sought out a fee-based advisor with a reasonable fee that didn't use mutual funds. However, there are a substantial number of ETFs in my portfolio, and I know these funds still come with a cost, but I think that they have their place. When do you recommend using these types of funds?
Yeah, Marshall, that's a good question.
It's a great question. I just love the fact that Patty knows what an ETF is. We talked about technology in one of the earlier segments and talking about reducing fees and reducing risk. Patty, if you've got ETFs in your 401k, that's a good sign. And we're starting to see more and more 401ks start to reduce the fees and bring ETFs into the portfolio. Because Casey, the reality is that the mutual funds have been sweeping these high expenses under the rug for years and years and years, and it's frustrating because we see it firsthand.
Yeah. Well, and Marshall and I work very close together. We share a similar office space, so we're working right across from each other. And the other day, I saw you auditing a portfolio, and you had some mutual funds in there that about knocked you off your chair.
Yeah, especially, and they were in non-qualified accounts. Because
I saw it over 3% a year.
There was 3 funds over 3% a year. And I think, Lee, that from your standpoint, that's probably something you don't anticipate a mutual fund having costs of 3.5% a year. And there's a lot of people out there going, well, I looked up the expense ratio, Casey, and it said, 1.25 or 1.5. And what we have to realize is if we have these inside of after-tax accounts where we're having taxation every time that mutual fund buys and sells, that is costing us each and every day, and you have to be aware of those
There's
things.
a high tax cost of that can easily double the cost of your mutual fund. There was a great article in the Wall Street Journal that stated those costs can easily double the cost of your mutual fund. The average index fund cost is about 0.44% a year, so a little less than 0.5% a year. Our ETF portfolios that we use in our house are closer to 0.1% in annual cost every single year. And if we look at some of these mutual funds out here being 2 or 3% a year, that gets very expensive. If you're young, there's ETFs out there that index to the S&P 500, like VOO, the Vanguard Index Fund, tracks the S&P 500, is at 0.05% per year. 0.05%, that's 0.05 of 1% on an annual basis in cost. But you can can find some of those fancier index funds out there that can be indexed to the S&P and get closer to 1%. So that's why it's important to sit down with someone that can regularly audit those portfolios, because there are expensive ETFs out there that didn't used to exist 5 or 10 years ago. And now we're seeing more expensive ETFs be introduced. And so now it's just as important to have your mutual funds audited as it is to have your index funds or ETFs audited.
It's not so hard to overlook those fees when the market's on the way up, but when things look differently, you're going to feel it.
Yeah. Well, it's not all cut and dried too. They track different indices. Some track the price better. Some have a wider gap, and you just have to be aware of those things.
All right, we need to leave it there. We have a special offer for you we want you to know about for the next 10 callers. So pick up the phone and dial right now, 482-9559. We're offering a complimentary financial review of your entire financial and retirement plan. It's an opportunity to get an education about your money so that you can make really the best decisions possible as you move forward. So for the next 10 callers, Casey and the team make time on their calendar to sit down, visit with you, and give you your very own purpose-based retirement. Here's our question of the day. By what percentage did U.S. national debt increase during Barack Obama's 8 years as president? There's some scary numbers on the screen. We'll tell you which one is correct in just a moment.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college.
How will I remember you?
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
So heading into the break, we asked you this question. By what percentage did national debt increase during President Obama's 8 years in the White House? Casey, which one of those frightening numbers is true?
During Clinton's years, it was 37%. During George W. Bush's years, it was 86%. And during Obama's years, it was 88%. An 88% increase in the U.S. national debt over 8 years. Now, we don't even need to continue on that trend. We can keep it the status quo, and we can see that sooner or later, there will be a day of reckoning. And what is that day going to look like? And you have to be prepared for that. So I want to make sure that you ask yourself this question: am I prepared for the next major pullback? Am I prepared when things actually hit the proverbial fan, right? And we can be prepared by actually putting together a real plan, not one that just depends on the market doing consistently well in order for your retirement plan to succeed, but one that's planned for the best and prepared for the worst at the same time. And that can be done using a purpose-based retirement strategy where we walk you through each one of the major risks you're going to face during retirement. Rather than focusing on your assets and the return we're going to create every year, let's focus on the major risks and isolate each one of those one at a time, whether that's liquidity, income, growth, or estate planning. We're going to walk you through a case study here today because I often get asked the question, Casey, we hear you talking about these risks, we hear you talking about the different things we can do with our life savings, but what do you actually do when a client walks into your office? Well, this is someone that we've worked with in the near past, and we're going to share with you exactly what we did with this couple. And we're going to use John and Jane Doe for this case. They're both age 65. They had a 401k of $500,000. They had bank savings of $200,000 and an income gap of $25,000 a year. So they needed to create $25,000 a year from their $700,000 that they had in savings, $500,000 being tax deferred and $200,000 being after tax. The first thing we want to do is following that purpose-based retirement philosophy, maximizing our efficiency, is we're focusing on liquidity. We're going to use the bank funds, of course. There's $200,000 in the bank. They're spending $50,000 a year. We scheduled $25,000 of that $200,000 to be their 6-month emergency fund. That got set aside in our bank savings. We had $175,000 left over. We're going to move that out to step 4. Then we had number 2. We had to generate that $25,000 a year in income. We're going to use the 401k dollars for that. Why? Because that's why the 401k was created in the first place, for you to use for retirement income purposes. Our first step is to carve out $250,000 for protected income to guarantee their income over the next 10 years. We're trying to do this to avoid sequence of returns risk. So if we suffer any major losses in the market, it won't have to change the income strategy and won't jeopardize the longevity of that income need. Then we have $100,000 we're going to position for funds we're not going to touch for the next 10 years. So we've got our first 10 years of income, then we've got our second 10 years of income in a moderate growth portfolio and $50,000 left over that we can invest more aggressively. So what are we doing here? Well, we're investing like we're younger on some of these dollars. We often hear people say, well, I'm at retirement, I can't afford the risk anymore. Well, what we need to do is we need to buy you the risk to invest like you used to when you were younger on certain portions of those funds. Take the aggressive portfolio, for instance. At $50,000, we don't need it for 20 years, so if you're 60, it's like we made you 40, and 20 years from now at 7%, that'll be worth $100,000 to $200,000. So $200,000 in 20 years almost makes up for that first leg of income and recreates it. We still have $100,000 left over in the 401k. We're going to move that to step 3. Step 3 being growth. We need protection from potential inflation in the future. Dividend equities and commodities being the best places for us to keep up with inflation. That's where we've created that foundation, starting with our dividend growth model and then allocating a portion to commodities. And not just gold and silver, but really diversifying our commodity portfolio, investing in companies that pay dividends but are invested in those areas of the market that do really well during inflationary periods, like we may experience because of the government debt that's been created. So utilities, companies are investing in transporting oil through pipelines, storing natural gas, transporting natural gas, and miners and things such as that. So we can create a very diversified portfolio that's very much indexed for inflation, including things even in the fixed income market like TIPS. Now we've got some funds left over. We've got our estate coming up next. We've got $175,000 that came from our leftover bank balance. And we said, now what do we do after this? We've set aside your emergency fund. We've guaranteed your retirement income. We've set aside funds for inflation in the future. Why would you ever need to spend this $175,000? And they said, well, Casey, I don't know why we might need it. Who knows? Maybe we need it for an emergency. Maybe the grandkids need some help. We just don't know what that might be. I said, well, what's the most likely emergency? They said, well, probably health care. So we want to position this for health care, long-term care in a combo hybrid, but retain control over those funds. So we've got $175,000, still making a decent rate of return, but now it's also filling that long-term care need should they ever need it. And it's also got a death benefit to pass on to the heirs. So we took $700,000, set aside $25,000 for liquidity, $400,000 for income, $100,000 for growth, and the remaining dollars, $175,000, positioned as efficiently as possible in the estate. Again, we're trying to maximize efficiency, looking for the perfect investment vehicle to accomplish that exact goal that we've established for you and you've established for yourself during your retirement years so you can live the retirement that you deserve.
You know, I love that plan. It's so straightforward and it is easy for people to understand. What's the process like? How long is it going to take from my initial meeting till we get to that point?
Well, typically we have our first session, and that takes maybe a half an hour to an hour, depending on how in-depth you want to get. And after that first meeting, we go to a second session. That's our strategy session. And during that strategy session, we dig in very deeply to where you're at today and the plan that we can utilize moving forward to get you on the right track. In our third session, we're implementing the plan. In our fourth meeting, we're reviewing the written plan and going through it step by step so you know exactly what each one of those dollars are for and how they're going to operate and what you can expect moving forward. And then we're putting together our regular review schedule so we can get together every 3 or 4 months. And that whole process typically takes 3 or 4 weeks.
And the way to get started is to dial 482-9559. We'll see you next week.